Hello everyone, welcome to our new topic here about capital budgeting or investment decision. We have a question that has been set for us. Welcome all, it's yours running partner Dr. Maina Justice. So we have a question here that reads that there are two mutually exclusive projects under active consideration of a company. The two projects have a life of 5 years and have initial cash outlay of $100,000 each. The company pays a tax at 50% rate, and the maximum required rate of company has been given as 10%. The straight-line method of depreciation will be charged on the project. The projects are expected to generate a net cash flow before taxes as follows. We have been given the years and the projects that are Project X and Project Y. Then the required. With the help of the above given information, you are supposed to compute the payback period of each project and the average rate of return of each project, and also the net present value of the project. So what you can see here is that this question is based on a topic on capital budgeting in financial management, or what you call investment decisions. So you must be asking ourselves, what is this thing that we are calling capital budgeting? We usually say that it is the process of evaluating specific investment decision. It is the process of evaluating specific investment decisions. Or we can say that capital budgeting is the process used by an organization or a company to determine whether a long-term investment is worth pursuing. Therefore, we can say that capital budgeting is used to determine which non-current asset purchases should be accepted and which one should be declined. So in that case here, we can think of Project X and Project Y. Are we going to accept one or the other? But we have seen this is all about investment, so we have the various classification of investment in any company. One classification is what we call independent investment, and also we have what we call mutually exclusive projects, and also what we call the dependent investment project or the contingent investment project. So from our question, we already given that it is a mutually exclusive project. It is a mutually exclusive project. So what you can say that a mutually exclusive projects are those projects which have the same purpose, or they serve the same purpose, and they do not compete, where choice of one will lead to rejection of the other, where choice of one will lead to the rejection of the other. For example, if you're in a mall that has an escalator or a lift, once you choose the escalator, it means that you have rejected the lift. So in that case, a choice of one leads to the rejection of the other. So in such a question here, we are supposed to give a decision such that if you accept X, you're supposed to reject Y. But before you get to that, there are usually various techniques of capital budgeting, and one of them is what we call the traditional method and the modern method. So yeah, there are usually two. We have the traditional method, and also we have what we call the modern method. The modern method. In the traditional method, we usually have what we call the payback period. It is divided further to payback period, and the accounting rate of return, or what we call the average rate of return. Those methods, as the word suggests, there is a traditional method. It is acceptable to the traditional financial managers in a company. But once we go to the modern methods, we usually have what we call the net present value. Also, we have the internal rate of return and what we call the profitability index, or the PI. The initials is NPV, IRR, and also PI. So those are the methods that we can say, or the techniques of capital budgeting, Back to our question. We have been told to compute the payback period of each project. That's the first step there, the payback period of each project, the payback period of each project. So what you should be doing here is that we should start with the first solution there, and one of the things that we do is have a summary of what we should be having here. Solution. So in the solution, simply make a summary, and in that summary we have to ensure that we have a guideline on what is guiding us here, and we have been told that the initial cash outlay is supposed to be $100,000. Then you have been given that the tax is 50%. The tax is 50%, and also we have been given that the number of years of this project is supposed to be 5 years. The useful life is 5 years, but the interest rate, or what you call the R, is given as 10%. So with that simple information, we also told that this institution or this company having these two projects, it has a depreciation, and in that case that investment have a depreciation, and now we have been told that it is following a straight line method. So to compute for the depreciation, we have to have the value of the investment, which is 100,000, divided by the number or the useful life of the project, that is 5 years. So in simple terms, we are saying that it is equals to 100,000 divided by 5, which tells us we have a value of 20,000. So the depreciation is given as 20,000. The depreciation is given as 20,000. So in that case, we have to produce for project X and see now what happens as the payback period. Project X, and in the project X we are given the number of years, that is year 1, year 2, we are given up to year 5. So we have the number of years there, year 5, so we move up to year 5. But we have been told that this project have some cash flows. They have some cash flows, so the cash flows are as given here. So we have been told that the cash flows are 40,000, so they are uniform. 40,000. So in that case, I can have it in terms of the figures there, 40,000. So if they are uniform, I just scroll down there and I get to 40,000. Then what I should consider is that I have to deduct the depreciation. I deduct the depreciation, and I'm told that the depreciation is equals to 20,000. That is what I found there, but now because we are deducting, it have to be minus. So minus 20,000, and we are saying it is uniform. So in such a case, we have found that this is the depreciation. So to get the earnings before tax, because we have to compute the earning before tax and interest, we are saying that the earnings before tax, earnings before tax is equals to this summation, or the totals of this amount here, the cash flow minus the depreciation, we get as 20,000. So the earnings before tax, it is 20,000. The earnings before tax is 20,000. So we have now to deduct the tax. So less tax, and we are saying is at 50%. So in this case, we have to deduct tax at 50%, and here we have to compute the earnings before tax. We are saying we have to have 50%. We multiply that by the amount here, which we have to get is as the tax. So we have our figures there, which we have to less earnings before tax, so that we can get the earnings or the net income. This is the earnings, or we can call it the net income. So in simple terms, the earnings, we stated that this have to be deducted, so we have to say simply this is a minus there, so it turns into bracket. We usually say that in finance or accounting, anything that is in bracket is a deduction. So in this case here, we have our total here, which is The answer there we get as this amount here, and finally we get it as 10,000. That is what we are getting as the net income. But in this case, we have to compute the net cash flows after tax. The net cash flows after tax. And how do we get that? It is equals to the cash flows minus the net income. So what do we get as that? That is equals to the answer there, which is 30,000. And because everything is uniform, we just have it as there. This is a uniform computation. So in simple terms, we get the earnings or the net cash flows after tax. So we now go directly to computation of what we call the payback period. I just use the ununiform method to compute. So we are going to compute here in two methods, such that we have the ununiform method, whereby you might be finding this is 60, 40, they are ununiform, but this one is uniform. So in that case, we compute what we call the cumulative frequency. And in the computation of cumulative frequency, the first part is equals to the amount there, but the second one is the addition of those figures, which is the other part there. So all of them have to have the same formula there, such that if you add them cumulatively, the total will be 150,000. So now that is in terms of computation. So let's see, in answering our answer here, we can say we are answering A, whereby we are told to compute the payback period, and now is a payback period for project, because there are two projects, for project X. So in that case, what do we say? We say that project X has some figures that runs down, and you want to have an initial investment of 100,000. In payback period, we usually say that payback period is that method that usually gauges the viability of a venture by taking the inflows and outflows over time to ascertain how soon a venture can pay back. So if I have invested 100,000, after how long will I take to get back my money? The payback period is that period of time or duration it will take an investment to generate sufficient cash inflows to pay back the cost of such an investment. So anybody in the market usually go to invest, and they usually have a capital to start a business. So for example, in this one here, we have a project that is investing 100,000. So how long will it take for project X to pay back the 100,000? So what we can see here is that at year 4, we have 120,000. That is exceeding 100,000. So in that case, we have to consider the above. So it is taking us 30,000 year 1, 60,000 year 2, and 90,000. We have gotten 90,000 at year 3. 90,000. So in simple terms, we are saying that it will take us 3 years to get to 90,000, but we want 100,000. So there's a balance of 10,000. So we look into year 4 or the next year, and the amount that will be realized here is 30,000. It is 30,000. So how do we compute that? We say that the payback period, period for this project, we can just indicate is in issues. The payback period for this project, the payback period for project X will be given by, it is equals to 3 years, plus, remember, we have 10,000 which is remaining to make it to 100,000, plus 10,000 divided by 30,000 That gives us a figure that is up to 3 years, 3.0 0.3 years, 0.3 years, 0.3 years. Because if I compute that is that 10,000, if I'm not wrong, 10,000 divided by 30,000 gives us 0.3333, so it's just 0.3. And in that case, if you add with the other years, it becomes 3.3 years, 3.3 years. So if that is the case, I can look into the months. And this one, I just multiply with the months that are there. And this is, remember, a year has 12 months. So I just multiply with 12. And I find that it is 3 years and 4 months. 3 years, sorry, 3 years and 4 months. So it will take me 3 years and 4 months to recover the amount I've invested in project X. That is what it will take me. The 3 years plus the other months, which are 4 months, to recover the amount. So in that case, that is what the project will be giving us. So that is in terms of computation if we are considering that they are non-uniform. That is a procedure. But you can consider the procedure whereby we say that they are uniform. They are uniform. In simple terms, you usually say that it is equals to the payback period can be computed as the initial cost of the venture, which is usually 100,000 here, 100,000. You divide all that by annual incremental, or what increases each and every year, which is 30,000, which is 30,000. And in simple terms, you can say that 100,000 divided by 30,000 will give us 3.3 years. 3.3 years. So it's the same as the other one. Now you can convert back to 3 years and 4 months. They are similar. So that gives us in case it was ununiform or in case it was uniform. So that is for payback period for project X. So let's see project Y. Project Y, for me, I'll just copy the formulas here and indicate that this is project Y, and now have the amounts, and they'll be computed as we have them there. 60,000. We also have 30,000. We have 20,000. We also have 50,000. We also have 50,000. They are the same. So in simple terms, what you can see there is that we have some computation that have been shown on how project Y will be moved. Remember what we did in the depreciation part, and we got the earnings before tax, then we deducted the tax, then we got the net income or the earnings, and then the net cash flows after tax, and also the cumulative frequencies. So now we can compute the payback period for project Y, and we have stated that a payback period method usually shows after how long will it take for us to recoup or to recover back our money that we have invested. And in this case here is a similar thing. We have invested 100,000. So after how long will it take us to recover that amount? After how long will it take for us to recover that amount? So here we found that to make it to 100,000, it is in year 4, but year 4 is in excess. But once we come here, is the same thing. Year 4 is in excess. So we move to year 3, and we find that it's the same thing, that payback period for project Y is equals to 3 years. Is equals to 3 years. 3 years plus what is remaining there. What is remaining to make it to 100,000? 100,000 minus 85,000 gives us 15,000. So it is 15,000 divided by what will be realized in the next year. Not the current year here, but the next year, which is 35,000. 35,000. So simply I can say that if I divide and I get the figures where we have 15,000 divided by 35,000, it gives us a figure there. This is in decimal points. So in that case, it tells us that we have 0.43 years. 0.43 years. So in that case, we are saying that the project has 3.43 years. 3.43 years. But you can go further and see what are the months. So we now multiply that number of 0.43 times 12. And you see the months. So we are saying it is 3 years and 5 months. So we can change this one here and say it is 3 years and 3 years and 5 months. 3 years and 5 months. So in that case, we have computed and seen that the payback period for project X and also for project Y. So in making the decision for this case here, we usually say that the shorter the payback period, the better for the investment. The shorter we take to get back our money, the better. So if I have invested 100,000, I would prefer to get back my money very fast. It should not take a long time. So in this case, in my conclusion here, I can state that project X is taking 3 years and 4 months. Project Y is taking 3 years and 5 months. So project X in capital letters. So project X. So I can say that project X is the best to invest, since it has a shorter payback period. So in that case, this is our decision that we should be advising, because in financial management, you have to make a decision at the end because you are advising somebody on what to do. So if you're investing an investor and you're using the payback period, and we have said that it is a traditional method and it is preferred by the traditional managers. So you'd be advising here and say that project X is the best for investment, since it has a shorter payback period as compared to project Y. So in that case, we have been able to solve the first part there, whereby we are saying that we have to compute the payback period of each project, and we have made a decision because the question is saying about it is a two mutually exclusive project. If it's a two mutually exclusive project, you have to make a decision at the end of the day there. So the next question is talking about the average rate of return of each project. So see me in the next video, whereby we discuss the solution on how we can compute the average rate of return of each project for the same question. In the meantime, goodbye and enjoy your revision.